So, hello. Today we're going to look how we can construct our portfolio, individual portfolio of equity funds. We'll start with gathering the data. So you can see I already have some figures here. These are weekly returns of 14 different funds. Well, most of them are Vanguard, but you can pick whatever you like. So where do you get the prices? I took them from Yahoo Finance. So you can just type in like what we have already here. Not the fund, sorry. On real estate, for example, you go for historical data and you take weekly, monthly, or like what's your preference. I took weekly just to have like with smaller amount of observations this time. It will be easier to maybe show you this. And then you take 5 years, at least 5 years, if you can. If your funds have such a history, I would advise go with 10 years. This one does have so much. Then you click apply and download the data. And okay, let's go through one of them. And so let's open it. If you don't have your Excel already splitting them in the columns as needed, then what you need to do is pick delimited, then comma separated, and if your regional settings is not like dot as a decimal separator, then go into advanced and change this decimal separator to dot, so it will recognize it. Select the first column and your month date, so it will recognize dates as well. So let's finish this, and then you're in adjusted close. So basically you can delete everything else and leave just this, rename it to the fund or ETF you're going to use. And well, these are prices, these are not returns, as you might understand. So in order to actually to get the returns, you need to do a simple calculation, divide the like for example the second date by the first date meaning the older one period back, and minus 1. So it gives you a percentage change. If you want, you can format it as a percentage. Double click on this corner. So also, well, with Yahoo Finance, I would advise to double check if all of this data is actually a number. So you can select all your returns, go here. If you see a sum, that already means all of the values there are numeric, so no errors, so everything's fine. With the most popular fonts, it will be that you will have no issues, so don't worry about that. If you take like very highly trade, like for example. So, well, this is how you get it, and then you just stack them together like um, next to each other. So just to have it in one place will be very convenient. I'll show you how it looks. In my case, it's these are adjusted closes, returns from them, from the oldest to the newest, sorted. So once we have the returns here, we want to copy these names next to it, like 2 columns further. You can name them like average. This is what we are going to calculate here, and STD stands for standard deviation. So formula we want to do here is average. Average, and we take according column. And since these are weekly returns, we multiply by 52 because we have 52 weeks in the year. And for the standard deviation, very similar. Standard dev S, which is for sample, because you don't have the full population, it's impossible to have because you don't know the future. So, and to make it right, you have to take a square root of the multiplier for the periods, in this case for the 52. So if you take daily returns, Yahoo Finance will give you business days, so you'll have to go with 256 days, if I'm not mistaken. So multiplier will be 256 instead of 52. If you go with monthly, then it's 12. So I don't have to do this. So let's copy this, and what I like to do is just go to the end. In this case, we don't have that many assets, but if you have more fonts, you will notice it's a lot more convenient if you can just not to drag everything or write it one by one, just to have it here. Now you also want to have a separate sheet for portfolio where you're going to build it. So I already have the font listed here as well, and average return. You might already guess you will have the same value that we had there. We will add them here. So how you can do it? Lookup or horizontal lookup. That's one way of doing it. We will take this value, and I think I will make it like lock in the column, so you can either type manually the $sign or press F4 until you have this, like I did just now. And now next thing you have to select table, and then it's gonna be this table. So and F4 once again, just to lock in this this range. This will not change. And the next thing, index, row index. In this case, it's 2 because we want to have like 1, 2, this row. And the last thing is, do we want to have exact match or not? Of course, we want to have exact. I'm not sure why Microsoft has it by default that we don't want to have exact match. So we can expand this. And you see it works if you copy it down. It will also work here if we change one small thing. The number 2 becomes 3 because, as you notice, this is third row, and this is standard deviations here. These are standard deviations. And oh well, everything's fine. We can calculate return to risk, return risk ratio. Some might call it a Sharpe ratio, but Sharpe ratio would also imply that we add or subtract the risk-free rate, and this is not the case here. We'll ignore the risk-free rate since it's negative in many places in the world now. I'm not sure if it would give meaningful results. So let's stick with this. Alright, so far so good. Next thing that we need to do if we want to do a simple Markowitz optimization, we need a covariance matrix for these fonts. So we take these names. I also notice that the order is important, especially with this Markowitz setup, because these formulas, that's how they work in Excel. You will have to do the matrix multiplications, and that requires you to have same order here in covariance matrix as you have here in portfolio. So how we calculate the covariance? The formula is actually very simple. Covariance, again, sample covariance, because we have only sample of these, and just select the column that you need. In this case, we have twice the same column, but what I do usually, I lock one of the columns, either the first one or the second one. You choose what you prefer best. And now that I have locked it in, I can drag it to the whole row, and now you can see that it actually has these values different. Like it's like keeping the tau as a second column. This is for everyone, and then the first argument is the column here, like what we have. I would like a time saver here is that if you can just change these diagonal values, I will just mark them so you can see. And this is also why I chose the whole column. If you don't do this, then you well, you can't just drag it down, so drag down the different values as well. So this is column C, so we change this to C. Of course, also it might seem convenient for you to do this action in the same sheet as the returns, then you can actually visually drag them. But believe me, if you have a lot of these assets, if you have like 30 or more, then it will be a problem. And also there's a limit to how many assets you can have in this Excel solver. It has a limit for how many variables you can have. Can't tell you for sure how many, and I know definitely you can go with 30, like that's for sure, but I also know that I have reached the limit at some point, just don't remember at the moment how much was it. But I believe for individual, most likely you will never ever have such high amounts like to actually to worry about it. I mean, if we take into account the cost for trading to actually buy all those funds, you don't want to spread the wealth too much. You want to be smart with this. You want to have best investment for best return for your investment, and the more rate the more money is spent on fees, the more return you require to actually be profitable. So I would advise to stick to like below 20 for sure, like if you have a lot of money to spend. If you don't have a lot of money, stick with 5 will be fine. If you choose the funds that are really different, like really different. These I just picked not quite randomly, but they are like focusing on different things. That's why I took almost all the Vanguard funds. They are like they have their own agenda, sort of what they want to accomplish with their setups. So I was hoping this should give us a good minimum variance portfolio at least. So almost done here. So what's going to be next step? Next step, we need to set up the weights and the calculation for these risk metric, basically. So why do we even care about covariance? Like, what it is? It's basically how this is a measure of linear relationship between two assets. Like in this case, it's okay between themselves, but like in here it's like this asset against this asset. How do they move? What's their relationship? And this like if this number is positive, like actually in most cases here, in all the cases, sorry, then that means that they're like moving in the same direction. And like if one moves by this amount, then like this is about basically the strength of the relationship, how much both move in the same direction. And the wonder of like this wonderful thing of this Markowitz portfolio is that if you spread your wealth among several assets, you can hugely decrease the risk you're having in your portfolio. We'll see it in a moment. So let's say so wait, and like what I usually do with optimizations, I do an equal weight portfolio. We have 14 assets. We'll have also a benchmark, sort of benchmark portfolio that against which we will check how we look. Like benchmark, if you don't want to be like super professional or whatever, then benchmark is equal weighted portfolio. That's like very good benchmark, very good to go because it's kind of reflects that no decision made portfolio. So it's no decision, just spreading the wealth equally everywhere. So measures we want to use. Oh, the expected return, that's silly because we will not have, like, we don't really expect this since this is just average historical return. But very often people actually like to call it like expected return because of the law of big numbers, meaning that like the most frequent or the average value is expected to appear most often. This comes from the normal distribution, the Gaussian distribution, where mean equals median, meaning that the most frequently observed value is also the average value. But as you might know, if you have learned anything more like about the investments, the returns are not actually applying. They don't really go along with this normal distribution. So don't really get your hopes up if you have a very awesome like historical average. This will most likely not be true in your future, but just for simplicity's sake, we will go with this assumption that this is going to be our expected return in our future. Well, let's keep it just like this because it's really no sense to go after common because well, I don't really expect this portfolio to perform this well. But what is true and what you can notice that if you minimize the risk, it will actually be lower than like if you go with the benchmark or equally weight portfolio. So let's go with the risk formula then. So first of all, we'll need to take a square root of it because that's the standard deviation is a square root of the covariance, and covariance we'll calculate by multiplying the matrix multiplication, sorry, matrix multiplication of equal weights, to our weights, sorry, and need to transpose them. But actually, it shouldn't really matter the order, but we'll use weights twice. So first of all, we transpose these, and not to forget anything, two multiplications taking place. Maybe you know, if you like multiply a single vector with a matrix, you will get a vector, and if you multiply a vector with a vector, you will get a single value, and this is actually what we are trying to do here. So square root is, of course, this is from single value, but matrix multiplication, so this is vector against matrix, we get a vector, and this is a vector against vector. This is vector, like a range, single column, that's a vector, and then our covariance, this is matrix. We will lock it in with F4, close the first parentheses for the first multiplication, and now the second multiplication, we get vector here in from this. Then go back to this and take weights again, but this time we don't transpose them because like if we had transposed them, that means we had a line of values here, a line multiplied with this matrix, we got another line which is vector, horizontal vector. Now we need to multiply with a vertical vector just to have like just one value, otherwise we wouldn't have that. I think you can Google this if you want to. Oh, sorry, one thing I forgot to say. Need to go with Control Shift Enter when you end this. And another thing, we had a weekly return. So square root of 52 is our multiplier for this. Now we got the expected risk for both of them. Now, the optimization part. Well, basically, this is the easiest part. You go to Data tab. If you don't have Solver here, you have to go to options and add-ins, and need to tick it in solver add-in. So I think it's so yes, just tick in the solver, click OK, and it will appear. So you now click on the expected risk, click solver, and just remember another thing we need to do. Sorry about that. We need to have some of them. Not maybe huge importance here for like ourselves, but this is important just for the solver to have a constraint. All right, so set objective. So we want to have objective cell risk, and we will want to minimize it, and the changing cells will be these weights, and need to have a constraint, and in this case this will be equal to 1. You can have a lot of different constraints here, but at this point we'll just click solve, and it was pretty fast, as you noticed. A lot of allocation on one asset though, okay, but this is minimal risk portfolio, at least according to our calculations. So what we can do here, if we want to have some sort of visual on this, we can also do like draw them. I don't know, port versus bench. I don't know. You can call it like that. And what we're going to do here is we will sort of build how it will look, like how it would look if historically we would do it. Preferably, we would want to actually have backtesting of it, meaning that you take additional time series, like these time series, these returns. You take it for, like, for example, exclude the previous year or 2 previous years, and make a simulation, not simulation, but you will do this, what we will do here, for the years you excluded from the optimization, just to see if those were really performing well actually. So in this case we will not go into that much detail, but we will at least make show how you can visualize it. So we can start with 100. This is just a starting value, and now what we need to have, another reason why we need to have like the sequence matching in the portfolio sheet and returns and covariances. We'll now use multiplication, so we'll multiply the returns here with returns in the portfolio. So these weights, so not returns, sorry, so weights, and lock them in with F4. So close the parentheses and Control-Shift-Enter. Yeah, works, but we also need to have this and multiply by. So we will add this so weighted returns, because like just to have a change in this 100, so still have to say shift 1, and I will just copy this to here, but need to change obviously the weights here. It was in F column, yes it was. Alright, now let's copy it down. So should look okay. Ooh. Now let's have some visuals on it, just to have something for ourselves. I'll just copy it, portfolio. Looks okay. So portfolio, this is ours. Looks good on the downturns, as we can see. That's good. That's good. Okay, but another thing that people usually do here, even though I would not suggest this, so return to risk again, or you can call it Sharpie ratio if you want to, but or Sharp ratio, pronounce it as you want. But this is not the Sharp ratio anyway. This is just return divided by risk ratio. Also risk to return to risk. So how much you pay for each unit of risk you take, and well, normally if you have a solid foundations of your calculated expected returns, not average returns, but what you actually expect from each asset, then you can call this expected return of your portfolio, and then it's worth to actually do this calculation also to maximize return per risk. So we change the objective cell, change the optimization to maximization, and click solve. Okay, and well, looks even better. But then again, if we don't do a proper backtesting, this doesn't mean anything. But this is just something people often do. So just so you know, I will just change it back to minimize the risk. And another thing I would suggest is to add a constraint, maybe if you had, to wait, not to have them more than, I don't know, your preference, but not more than half in one. Or I would even say be maybe more conservative, go with up to 35, and not more in one asset, or not more in one fund. Doesn't matter how good the fund is, every fund can fail, so it's best to spread your wealth. And well, as I see this, there is not a huge drop in the performance in our case. It's, I would say actually we outperform the benchmark and we have the better risk. This is our optimal portfolio. This is good. This is what I would go for. Very small tower. That's real estate in China, if I remember correctly. So maybe I would like to have a bigger number here, but you know, you never know. Actually, you know that you never know what's gonna happen in China. So well, maybe this is a good one. So this is how you do a simple Markowitz optimization. I hope it was educational for you. You learned something. If not, let me know.